Hello, everybody, and welcome into VRIC Media, your most trusted voice in metals and mining. My name is Jesse Day. Today is December 16th, 2025, and we are bringing the VRIC to you with our series of expert panels. We have Michael Pento, founder of Pento Portfolio Strategies, available at pentoport.com, and Todd Horwitz, founder of Bubba Trading at bubbatrading.com. Gentlemen, it is great to get together for another panel conversation with you.
I'm glad we got it together. It's good. I'm here with my man, Michael.
Yes, yes. Well, we have to kick things off with the Fed's latest version of QE, which they're saying is totally not QE and it's only going to be temporary. They're calling it reserve management purchases. I want to read a quote from Reuters. The Federal Reserve on Wednesday said it would imminently start buying short-dated government bonds to help manage market liquidity levels to ensure the central bank retains firm control over its interest rate target system. Wow, that sounds like such a noble and great thing they're doing, the way that they word it. They're doing it to protect the system. So I wonder what both of your thoughts are on this development and how you see it potentially impacting the economy and financial markets. Todd, I'll go to you first.
Thanks, Jesse. Listen, the Fed is a totally broken organization that has absolutely no clue of how a free market works. Their whole concept of trying to control inflation is ridiculous. Their cutting of rates is increasing inflation and putting us more in danger of stagflation. They have done absolutely nothing to help anybody with the exception of the banks, which is obviously who created the Federal Reserve back in 1913. They either pulled the fast one over Woodrow Wilson or he was in on it. But the Fed has been nothing but a scam the entire time. They are not helping anybody other than building debt and destroying the value of current currency. The fiat currency system in which we operate under is totally manipulated and designed to make costs go higher. So what they're doing is just another round of bullshit, excuse me, of trying to create something for them and not anything to help the taxpayer, the citizens, and the actual people that need the help, because rates have not come down since they cut. In fact, the 10-year notes, when they cut the first time, were 3.9. Today, I think they're 4.2. So that tells you how good the rate cuts were and why the markets get so excited about it. You know, when you're in a K-shaped recovery, the top end of the K does well. The rest is struggles.
Yeah, great summary there. Michael, your thoughts on reserve management purchases.
Yeah. I feel like when Powell's on his meeting and he's giving his press conference and he says, okay, what I'm about to say has nothing to do with monetary policy. I'm just going to destroy the currency even at a faster pace. Don't listen to this. So I agree with Todd. So they are, of course, first and foremost, helping banks. That's what they care about first and foremost. But they also now are helping out the Treasury. Because, we financed all our debt with T-bills, and then we have to get that T-bill rate down. So you get interest payments below $1 trillion. So that's really what they're doing. But here's an analogy for you. It's like telling to the policeman, you're speeding 100 miles an hour in a 25-mile-an-hour zone. And you're saying, speeding isn't dangerous because I'm late for work. It's not that I'm not speeding to enjoy myself. I'm speeding because I actually have a purpose. I'm late for an appointment. But you're still speeding. So the Fed is still printing money. Their balance sheet went from basically $700 billion pre the Great Recession all the way to over $9 trillion. They managed to get it down to just above $6 trillion. And now that's just too low. Reserves in the system or they're so low now we have to start, printing money like maniacs again. And so they're buying $40 billion a month of short-term treasuries, but it's not QE. Because they're not doing it to bring interest rates down on the long end of the curve. They're only doing it to make sure banks function well and the money market rate is functioning well. I mean, I don't care why you're doing it. You're printing money ex nihilo out of nothing, and you're debauching the currency. You're expanding your balance sheet, and I don't care what the reason is. The reason is you're doing it to protect banks and to fix the interest payments with the Treasury. So in reality, they're destroying the middle class even to a greater extent. Yes, it's QE, and I don't care what anybody else says about it. That's the fact. The balance sheet is increasing, and your purchasing power is going down.
I want to talk about the precious metals for a moment here. The story of the year when it comes to the commodities market has been gold and silver, both metals reaching new all-time highs this year. Silver currently vastly outperforming gold. It's up at about 100% year to date. When it comes to both metals, do you think this is a time to be exercising caution as they could be overbought? Or do you think the greater risk is that they may run even further, leaving those waiting to buy the dip in the dust? And perhaps if you'd like, you can include the gold and silver miners along with the metal in your analysis here, Todd.
Well, I don't think that they're running too fast. I think you're first, if you're an investor or a trader, you have to determine what your objective is. I mean, if your objective is to buy it and hold it forever, then you can buy it anytime. I don't think it matters if you wait for the pullback. Certainly, the gold and silver run has a lot to do with the debt that we're creating. And of course, the inflation that we have. And the gold and silver are telling you that the debt is too high and that inflation is too high. And they're going to continue to run until they don't. I mean, I thought there was an outside chance we'd see $65 silver this year. Well, here we are. And I don't see any signs of slowing down. Yes, there'll be pullbacks. But again, the individual has to make a determination as to how they're going to deal with it. If you're a trader, you certainly wouldn't be looking to buy here. But if you're investing, you have to start investing at some point. There is no perfect time to be an investor in the precious metals. It should be a part of everybody's portfolio, whether it be 5% or 10%, because they aren't a hedge against stocks, but they certainly are a hedge against inflation and certainly the damage being done to the fiat currency system. Once again, there may be a point in time, Jesse, that we may have to have gold and silver as real currency because people may stop accepting the fiat currency system because it's such a broken down system and so over manipulated by central banks around the globe. So if you're an investor, I don't think there's any time to wait. You can buy some. You don't have to buy it all. You don't have to fill up your bucket. Buy a little bit. Be willing to buy more on the dip or be willing to buy more on the rally. But overall, I think in history has showed us that the precious metals continue to rally, sometimes faster than others, just like equities. And I would think that now is as good a time to buy some as any.
Michael, your thoughts on gold and silver right now. And if you have comments about the miners, feel free to share as well.
Yeah. So it's not just gold and silver, it's platinum too. Platinum's having a wonderful year as well. So yeah, I've been long them in and out of silver, long time holder of gold, long time now holder of platinum. I'm glad that they finally joined the everything bubble because, you had Bitcoin go from basically nothing to $120,000 a unit for basically a passcode. Of course, you have the housing bubble, which is out, it's unaffordable to the first time home buyer now. I think it's about 5.3 times incomes, record, even bigger than it was going to the housing bubble in 2006. And of course, equities are now 220% of GDP, the value of equities as a percentage of the economy. So they have been in a bubble. So I think all the liquidity that the Fed has created, finally like, hey, let me find a home for all this money that I printed. From basically the high-powered money going, as I said, from $700 billion to over $9 trillion, and now they're doing that same game again. So yeah, they've joined the bubble parade. So like Todd indicated, I can't speak what's going to happen in the next month or two. That kind of feels kind of frothy to me, especially with the silver complex. But what drives precious metals higher is falling real interest rates, and that of course has ancillary effects on the currency, and the progenitor of that function is an insolvent government. So I'm asking myself, what's going to happen in the future? If I'm looking out maybe 6 months, whenever the next recession manifests, you're going to see a Fed that's forced to cap the long end of the yield curve, the way Shinzo Abe did and the Bank of Japan did when they said, treasuries can't, their JGBs can't go above zero. So we're probably going to cap it at around 6%, because at 6%, the whole facade comes crashing down, stocks, bonds, and real estate. And so you'll cap the nominal rate, and the way you'll cap it is by creating a massive amount of inflation. So real interest rates are going to plummet. And that's going to be for the purpose of keeping banks and the Treasury solvent. And that's going to be a never-ending QE. I think the Fed's balance sheet goes well into the double digits. And that's when you're going to see these metals shine brighter than ever. So for traders, you can go in and out the way I do. But for long-term purposes, it's just the beginning for these precious metals.
Let's touch on the real estate.
Unfortunately, I'll add unfortunately there, because the value of your gold never changes. It's just the expression in the currency you're measuring it in. and that means your middle class is being eviscerated. And the miners, by the way, I mean, if you look at their costs pulling stuff out of the ground, the energy, that's falling rapidly as these metals go higher and higher. So I think the earnings are going to be spectacular for these precious metal miners.
And you had a comment there, Todd?
I just had one point to Michael's comment on people can't afford a house and how much it's gone up. And just a quick stat, 1985, the average income was 25,000. The average house was 75,000. Today, average income 70,000, average house just a shade over 500,000. So that's right to Michael's point. It's so much more than your income that people cannot really afford to buy new houses.
Our project is right in the southeastern corner of Wyoming. In the space of 4 years, fully engineered, fully permitted.
The ASIC is what caught my eye, $937 per ounce.
110,000 ounces per annum. First year of production is the most impressive. 132,000 ounces of gold, 24 million pounds of copper. You really want these things front-end loaded like that. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
Well, let's talk about the housing market for a moment, Todd. Before we hit record today, we were chatting about it. You were saying there's some signs you're seeing that lead you to believe that we are in a bubble and this bubble could be set to burst. Why don't you walk us through what you're seeing when it comes to the real estate market? And then, Michael, I'll get your thoughts as well.
Well, I mean, I definitely think we're in a bubble. I think that, again, you have interest rates continue to go higher. But now what you're starting to see is a lot of the builders, like out here in Las Vegas, where I live, a lot of the builders are now making deals on interest rates. Even though the mortgage rate is about 6.5% to 7%, builders here are now offering like 2.5%, 3.5%, and capping at 4.5%, which tells me that they're starting to get nervous about the inventory that they're carrying. And they've already committed so many funds to build all these houses in this construction. And I think when you look at it, when you start seeing deals on houses, on rates, when you start seeing the talk of 50-year mortgages, when you start having credit card companies willing to extend your debt out until 2027, okay, to me, that says bubble, and it's going to pop and burst. And I have no doubt that, again, I don't know when. I can never tell you when this is going to happen, but there are so many warning signs when it comes to the money. The Fed is panicking by what they're doing because they're making it harder and harder to provide liquidity to the borrower. They're protecting the banks and the lender. They are not protecting the borrower. And I think that you're going to see this whole thing burst into flames very much, if not worse than the 2008 housing bubble, because again, the average concept of the loss of jobs, the things that are going on, the income, it's just not there. We can't keep up with the rate of inflation that we're going at right now.
Michael, your thoughts on real estate right now in America?
Well, I wish there was the third person on this panel that we could argue with, because I feel like I'm just an echo chamber for Todd. I mean, anecdotally speaking, I live in Naples, Florida, and I have 2 properties here. I bought one in 2022. We closed on it in May of 22, and I'm down 20% on that property. I'm trying to unload it. 20%. That's I'm asking. The asking price, which I brought down significantly. If I get it, I'm down 20%. And guess what? I've got no offers, no bids on my house. Listen, the home price to income ratio is higher today than it was prior to the great collapse of housing in 2006, circa 2006. So, FHA Secure is the new Ninja loan, or the no doc loan. That was basically a non-event back then. And I think there's like $70 billion now worth of FHA secure loans outstanding. Don't quote me on that. I'm trying to go off memory, but I've had a bad morning. So don't forgive me if I get that one wrong. But here's the point. 25% of all houses that were sold since COVID breakout were bought by investors for Wall Street and investors. So they have all these people own all these single family homes, and they're going to be dumping them. They're going to be putting them on the market, because it's a very easy calculation just to call your real estate agent and say, listen, I own 5 homes. I'm dumping 4 of them because I only live in one at a time. And that's a massive inventory that's going to hit the market. And guess what else? Everybody who moved, they say, well, the problem is that Real estate is only an issue if you're living in like Texas or Florida or North Carolina. But that's where everybody moved from the Northeast and the upper Midwest. That's where everybody moved. That's where all these mortgages that were, taken out at 2%, 3%. And now if you want to refi that rate, you're talking about 6, 7% on your mortgage. So it's a problem. These homes aren't homesteaded, they're investor properties, a wave of inventory. And Todd's correct. It could be as bad for the banks as it was in 2007, 2008.
Well, pivoting back to the Fed, President Trump has strongly indicated that he wants continued rate cuts up ahead and looks to be installing a new Fed chair who will essentially follow his orders. Is this the total death of so-called Fed independence? I mean, they at least tried to keep up the illusion that it was independent. And if Trump gets his way, what will continued rate cuts do to the economy and precious metals prices? Could this be fuel for another leg up in this precious metals bull cycle? Todd?
Go to Michael first, so we're not always in agreement.
All right, let's do it.
Well, Trump was actually quoted as saying he called Powell a stiff. I mean,
Yeah.
I mean that's probably one of the kindest words I've ever used for Jerome Powell. But yeah, he is a stiff. But he cut rate by 25 basis points. Trump wanted him to go at least double that, and maybe more. And he was quoted as saying the other day that he wants the Fed funds rate at 1%. And that wouldn't be so bad. Actually, it's terrible because, there's supposed to be an independent organization. Institution is supposed to be completely separate from the administration, but it really isn't. They actually work on behest of the Congress, who helped put us in this debt insolvent situation in the first place. But you have Governor Moran or Miran. I'm not sure if I'm pronouncing his name right. Okay.
Moran's good.
And he's out there saying he wants a series of, he dissented from the 25, not because he thought, well, inflation has been above our asinine 2% target because our target should be 0. But we went to 2%, but inflation has been above 2% for almost 5 years now. So I'm not dissenting because I don't want a rate cut. He dissented because he wanted 50 basis points, a series of 50 basis point rate cuts in supposedly an economy that's an A plus economy, relatively full employment. I mean, 4.6% unemployment rate, which we got today, which is very low historically, is still higher than it was, 2 months ago. But, I want to say one thing about that unemployment rate, that report that just came out today. Over 900,000 people, an increase from September to November, were reported as working part-time for economic reasons. This is a very weak labor market, and the Fed can't fix it because the problem with the labor market is both technology, AI related, and the fact that we, thank God, closed the border. That's the problem with the labor market. So you're not going to fix it by destroying the purchasing power of the middle class. That's their prescription for everything. Cut interest rates and print money. So I don't know if Todd's going to agree with me, but I can tell you this is a disastrous monetary policy, which rhymes perfectly, fits perfectly together with their unbelievably horrendous fiscal policy.
Todd?
The morons at the Fed. Okay. And again, listen, I'll be honest, I'm a fan of President Trump, but this is totally out of line and totally wrong. You cannot continue to cut rates in this market. And this is the problem. When the Fed started by the four crooks that it started with, which was Paul Warburg, the Rothschild family, Rockefeller, and JP Morgan, they never had the best interest of the people in mind. It was to protect them and to continue to let them build wealth. Well, again, this is just another sign that they're trying to stand on the side of the banks. We cannot afford any more rate cuts because all the rate cuts have done is push inflation continually higher. And if you think we're anywhere close to 2%, then I got a bridge to sell you in Brooklyn somewhere because we're so far above 2%. The average consumer can't afford to live. And as Michael said, here you have, they're working part-time jobs just to get by. Not to mention that if you're on Social Security, you have nowhere to go with your money. Okay, you don't have any money. And certainly the cost of living that they give you does not anywhere near keep up with the expense. So we have to have a market, and interest rates should be traded through a free market system. But of course, the Federal Reserve has done a good job going back to Alan Greenspan, the original bubble builder who started this mess. And we continue to see that we have a higher inflation, higher cost. Yeah, money is cheaper, but can you get the cheaper money? And the answer is no. So all it's really done is, once again, has done a big benefit for the banking society and for the very uber wealthy. But for the average guy in the street, this is nothing but garbage. And of course, it's showing that the Fed has no clue about how to let it market price itself, because asset classes, as Michael was telling you about his house or his condo in Boca, he's trying to sell. Okay.
House, Naples.
Okay, he's trying to sell it. He's trying to sell it to a free market. He's got an offer. He's looking for a buyer, a bid, and somewhere there may be a bid. That's how the interest rates market should trade too. Because the truth of the matter is that real interest rates from the average guy who's borrowing them are higher than we can see now. If you go to these peer-to-peer lenders, you're paying 12, 14, 15% for money right now. So the Fed, again, you become a Fed governor, you become an instant moron, and they have no clue of the free market, and that's what we're watching, the destruction of the free market.
That's why now they're not only moronic, they're hiring people like Stephen Moran.
They're more bigger,
who actually
bigger morons.
appropriately named.
And we'll get an AI Fed governor, which again, look at all the jobs that we just lost. I mean, between Amazon and UPS, right before Christmas, they laid off 80,000 people. And those jobs are back.
I want to say one more thing, because you'll hear a lot of BS in the mainstream financial media. They'll say, "Oh, but incomes are keeping up with inflation." Well, not only that is complete BS, because they undercount inflation habitually, but what if you're retired or unemployed or underemployed? Are your incomes keeping up with inflation? And that cohort I just mentioned, there's tens of millions of individuals in that cohort, underemployed, retired, and unemployed. So incomes are not keeping up with inflation, even if you have a job.
And Todd, you mentioned the death of the free market. I think that's something that's front and center right now. I mean, we essentially have what some would call an oligarchy in the United States, because these big tech company CEOs and other corporate interests are the donor class that is allowing these politicians to be elected. This is a major systemic issue and something that is often not pointed to, but I think it's a major cause of the problem here. Do you think the way the political system is being run, it's not only in the US, but we're US centric right here, so we might as well focus on that. Does that need to be completely overhauled? Does that need to collapse and change for any of these issues to be resolved? Because we have these perverse incentives where these politicians are running for a 4-year term or whatever it is. They could care less what happens when they're out of office. They're just trying to make as much money as they can for themselves, their family, and their inner circle before they get out of there. And then it's kind of out of sight, out of mind for them. They go and move on to some high paying position in a company or something like that. What do you guys think about how the current system is set up, and does it need to collapse? Michael?
Well, first of all, you have to put term limits in there. I know these people in Congress that sit there and they have they're there for decades, and then their kids take over. There has to be term limits. When the government shuts down, you don't get a salary. Why does Congress get paid when the government shuts down? You need to infuse the whole system to be more reflective of the free market society that our founders envision. You take, like medicine, for example, the healthcare industry. How come when you go to a doctor, there isn't a price list? You go there, I don't care if you're dying, they'll say, where's your insurance card? Oh, you give me the insurance card. Well, I'll let you know what we cover and how much your bill is. And then the healthcare company gets paid by making sure that you're not covered for your needs. So there should be free market openness in the healthcare system, tort reform, term limits. We need a dose of free market capitalism in the society. And having the president of the United States or an administration, a president who I fully support and voted for twice, having him dictate how low interest rates can go so he can tell everybody how great the economy is and how great he's doing, it's blasphemy. It's political blasphemy.
Todd, your thoughts?
Well, Michael, I hate to agree with him again, but I have to agree with him. I mean, again, there's this whole mess that's created. I mean, again, I don't care whether you're left or you're right. It really doesn't matter when it comes to this, because they both steal equally. Nancy Pelosi went into office with $3 million. She came out with $153 million. Okay. I mean, why would anybody spend $40 million of their own money to get elected to $195,000 a year job? Okay. Because it's always the back end. This has been going on forever. And until they wake up and say term limits, which is, I don't know that will happen. It won't happen in my lifetime. Okay. But the only way we can solve this problem is to break the system down. Okay. And get into real term limits where you can't serve your entire life. I mean, look at Joe Biden. I mean, here's a guy that had Alzheimer's that was serving. Okay. Look, we have a very bad system. We've been far too easy in letting things go by. And of course, a lot of it the blame goes on the voters. Okay. Because you have voters that vote one way no matter what. It has nothing to do with the issues. It has nothing to do. We need to have term limits to cut this crap out and to get rid of the criminals because there's many criminals in office, okay, on both sides that have been stealing money since they got there. And again, it goes back to people spending millions and millions of their own money to get a $200,000 a year job. You do the math and tell me what they're really doing. They're really getting in there. And these are all the bad deals we made with the healthcare system. The Affordable Care Act is an absolute joke. Obamacare is an absolute joke. I mean, again, if we took it back to the private free market, people would be a lot happier and they'd be paying a lot less. But when you take it out of the hands of the free market and you let the politicians get paid through graft money on these kinds of deals, it doesn't work out well. So when you destroy a free market, which is what we've done systematically over the years, you take away the freedom of the individual and you put it in the hands of government, which is the absolute worst place it could possibly be.
Well, I want to pivot to Japan for a moment here because yields on Japanese sovereign debt have gone from the bottom left to the upper right of the screen this year. Almost across the board, we're at all-time highs in the JGB market. Is this a debt crisis in the making? And if so, what could the implications be for global bond markets and the broader economy, Michael?
Well, that's where we're headed. We're heading to interest rate repression. So under the regime of Shinzo Abe, the Bank of Japan had interest rates I'm talking about benchmark JGBs, 10-year notes were between 2016 and 2022 were 0%. 0%. So now today they're pushing 2%. That has ramifications for something called the yen carry trade. The yen carry trade is where you go and borrow yen at basically zero. You go out and you sell that yen, you buy dollars or reals or euros, whatever. You go around the world and you buy their bonds and you buy their stocks. And you get a higher yield, you get a higher return. And then when you repatriate those dollars back into yen, the yen has fallen. That's called the yen carry trade. And the spread between specifically dollars and yen used to be about 400 basis points. Now it's 200 basis points. So that carry trade is attenuating greatly. And that has ramifications not only for bonds. For example, Japanese investors now have an opportunity to buy their own debt. And when you factor in currency hedging, it's cheaper to buy their own debt than it is U.S. Treasuries. So there's another buyer, along with China and anybody else who doesn't like having their currency reserves confiscated, and they would rather hold gold instead of having treasuries, which are backed by dollars, which are being destroyed. It has ramifications for treasury bond prices, which are going to go down and yields to go higher. And it also has ramifications for our stock market. One of the reasons why I think in was it early November, November 6th, I believe was the date, where the Fed funds futures market priced out a rate cut for the December meeting, and everything went to a correlation of 1. The yen was spiking at that. The yield was spiking on JGBs, and it was the dissolution of the yen carry trade. Everything went a correlation of 1, and everything got dumped. That's when Bitcoin went down 30%. In 5 or 6 trading days, the S&P lost 5%, and the NASDAQ lost 5%. Everything was going in a flush, free fall. And then we had Governor Williams, Fed President Williams, John Williams, said, "You know what? We were just kidding. Don't worry about. Don't listen to the Fed funds futures market. We are going to cut rates for sure in December." And then, of course, he told all of his blow buddies on Wall Street that we're also going to launch QE, and the markets turned around quickly. So this is the crony capitalism. This is the situation we're in, but it doesn't change the fact that the yen carry trade is eroding. Yields are going to go much higher in Japan, and that has ramifications for all assets globally. Don't overlook it.
Todd, your thoughts on rising bond
What
yields in
else can I
Japan?
say? I have to agree with Michael again. I mean, I mean, listen, they've created a mess very similar to the mess that we've created here. Them holding even longer created this much bigger problem. And there's one problem when you put yourself in a position, the trade can only go against you when it finally has to mature. And this is going to be ugly, and this is going to be part of, I think, the global meltdown that I think Michael and I both agree that is coming at some point. Obviously, we don't know the timing of it. We can't tell you that it's tomorrow or next month or next year. But the whole combination of the debt that's been created, the carry trade, the way that we've done everything, okay, here and there, is going to create this massive meltdown. And you're going to see interest rates. I think that the 10-year notes will be north of 6% before you know it. Okay.
Yep, I agree.
And that is not a pretty picture when you look at the bigger, because most people that are still alive today, they don't remember what mortgage rates were like, what real interest rates were like. When I got my first house, my mortgage rate was 13%. Okay. So we have things to deal with, and this is not going to be pretty. This is going to be a very ugly explosion, and it's going to hurt a lot more people in '08 because less people are equipped today to deal with what's going to happen than were then.
Well, let's end on the broad market. All three big indices, the S&P, NASDAQ, and Dow Jones, have recently hit all-time highs. This is despite the fact that they're being held up by a tiny handful of mega cap tech stocks, mostly driven by the AI narrative. Both of you have been talking about the broad market also being in a bubble and potentially due for a large correction. We can't time the markets, but do you think 2026 is the year that we finally see this bubble burst and perhaps enter bear market territory? Todd?
It's possible. I mean, I don't want to make predictions. I mean, but I will say that only twice in history has the market had double-digit gains 3 years in a row and then continued into the fourth year. Okay. Again, I see no reason. I see an economy that is under dramatic struggles. I see the consumer is dying, okay, because of the K-shaped economy. However, the 20% or the 10% at the top of the K continue to fuel what appears to be an okay place. I don't see it. I think that this loss of jobs, the high inflation, the people don't have enough money, they can't basically survive. I can only see this ending very ugly. Is it going to be 2026? Maybe. Again, I can't predict it because everything has to fit into place, including Japan going kablooey, and here at the same time, it's certainly coming. I've been through this in 85, 86, and 87, leading up to 87. I was through this in 90, 99, 2000, 2001. And of course, I've traded on the floor for all those events, and I'm seeing the exact same types of warning signs. The real problem is when do they finally give up? And I think we're going to see a lot's going to be told. We just had record sales through Christmas season, but of course, that doesn't count the deferred payment on debt, but it also doesn't tell us what the profits were. Are the companies having record sales with no profit? How are they going to survive? The lack of jobs. So to me, it would not surprise me if we open up to the downside and go into a bear market in 2026. But I certainly don't want anybody to go act on what I'm saying, that I believe there's a bear market coming. And full disclosure, I am still long. I am still hedged. I am always hedged using derivative products to hedge my overall portfolio. But certainly, if I were looking, I would rather be to the short side as a trader than to the long side from here, because to me it looks like, other than the Dow and Russell, which just made all-time new highs last week, the S&P and the NASDAQ have both made lower highs over the last couple of months. So to me, that's also a warning sign.
Michael, your thoughts?
Well, a couple of things I want to say. So first of all, what's coming, what Todd's saying, what I've been saying, is probably the biggest calamity, chaos in markets we've ever experienced before. And it's going to be bigger than 2008. First of all, the national debt to GDP in 2008 was like 60%. Today, it's over 120%. The total market cap of equities back then was 107%. Today, it's 220%. And of course, we had the housing bubble back then. We have a bigger housing bubble today. If you look at the home price to income ratio. So there's a lot of potential energy there, but 2026 to me looks like a very dangerous year for two reasons. Number one, there's a tremendous amount of investment in AI, and AI is a great technology. It's going to be a big productivity booster in the future. So very similar to the internet, but much like the internet boom in 99, 2000, before it went bust, there was a tremendous amount of overinvestment, fiber optics and switches and routers. And of course, some of these companies, very viable companies like Cisco, went down 80, 90%. That didn't mean that the company was bad. It didn't mean that the technology was fallacious. It just meant that there was overinvestment. Well, now we have a massive amount of overinvestment in AI. The concentration of market value in these companies much greater than it was even in 2000. So, if you take out the Mag 7, the market hasn't gone really anywhere this year, and GDP has gone nowhere. But the investment in AI used to be supplied through cash flow. The purchase of these chips were derived through cash flow. Now it's, the circular financing, and debt is now hundreds and hundreds of billions in dollars of debt is being raised, and leverage is being taken out to buy these chips. So that's a big danger in 2026, is this AI bubble bursts. The other danger that I see that's very salient in 2026 that could happen would be the long end of the bond market bursts, because come May, you're going to get, perhaps. So the two people that may take over, both of those people are not really, Kevin Hassett and Kevin Warsh. Kevin Warsh is a much more sane individual. Hassett wants to cut rates more aggressively. Warsh wants to cut rates, but he wants to really eat into that balance sheet. He will not do QE. So he wants to really help out the middle class, but hurt Wall Street. So that's why I think we're going to get, and I'm guessing here, I don't know what's going to happen with the president's decision, but I think you're going to get someone we're not even talking about take over the Fed in May, mid-May, May 15th, and then the first meeting is June 17th. And he might get what I think will be an obsequious sycophant, as like I like to call him or her, who will aggressively cut interest rates and ramp up the pace of quantitative easing. And in that case, you could get short-term rates could fall, but long-term rates could rise inexorably, especially if inflation it does what I think it's going to do next year in the context of this fiscal and monetary mayhem and madness. So that could blow up the long end of the bond market, which could be a catalyst for chaos in markets. Those are the two things. And there's one more thing I want to say, and I know I'm going long on this answer. I do these interviews not because I'm destitute and I need money. I can manage my own money. I want to help as many people as I can survive and thrive what I see coming. And I'm going to throw Todd into this too, because I guarantee you a lot of comments I'm going to read. I would say, oh, these people have been saying this for a long time, and it never happens. Listen, I'm a student of history. I guarantee you Todd is too. Listen, go do your history homework. Look at 1929, the 1970s, the lost decade, the 2000s, the 2008, 2019 repo crisis, 2022. There is another crisis coming, and it's not going to be as easily solved as those other iterations, those other blowups. We're mollified by massive money printing and debt. If that happens again, you're going to have the long end of the bond market go ballistic, most likely. The odds are high, very likely that will happen. And that's going to just exacerbate the move lower in real estate and in equities. I'm here to help people. I want to get people, as many people in the lifeboat as I possibly can. If you don't think that that's possible, don't listen to these interviews and just buy SPY and go to bed. All right? But if you're smart enough to understand how bastardized the financialization of this country has become, and other countries around the globe too, that includes Europe and Japan and China too. And if you understand history, then you're smart enough to do something about it, and you still have time. Thank you.
Love it. Todd, tell us about Bubba Trading.
Listen, again, I'm with Michael. I mean, I'm trying to educate people. I don't need to do this. I could just sit home and trade by myself. I've been very fortunate. I was a floor trader for over 30 years. I've been a member of the exchange for 47 years. Okay. I'm trying to educate people and help people do it for themselves. Okay. And as I always tell you, I am long this market. I am hedged and I know how to hedge to an absolute mathematical certainty. But at the end of the day, if the market goes up, I'm not going to get hurt. I'm going to make money. If it goes down, I'm going to make money. But the key is you have to have enough education and understand how the markets actually work and understand history, that the markets are blaring warning signs at you right now. And they have been for a couple of years. But I said the same thing in 2006, that there were warning signs that needed to be looked at. And of course, everybody said no, because you keep hearing the news. Everything is great. Everything is great. But look at the average guy. Okay. Are they great? No. And of course, eventually it's going to come down to that. And I think whether you educate through me, through Michael, or on your own, you need to have an education to understand how the markets work and function and the changes that have been happening. And if not, as Michael said, buy SPY and go to bed, and you'll wake up and someday it'll be worth more.
Well, I'll put a link to Bubba Trading in the below. Michael, tell us about Pento portfolio strategies.
So just by the way, we're just doing math here. We're just reporting the news. A market, the price to sales, total market cap to GDP, risk premiums, the CAPE ratio. They all say the same thing. This is the most overvalued stock market in history. If you want to do something about that, maybe you could contact Todd, or maybe you can contact me. I have an algorithm that helps me time, not the day, but the time when we have a recession or a credit crisis. I'll be out and short. In fact, right now, like Todd, I'm net long this market and doing fine. A great year this year. Wonderful year for my clients. But if you want to be able to sit out a decade of falling nominal prices over that decade, and in real terms getting wiped out, then you can do something about it. You can contact Pento Portfolio Strategies. The website's pentoport.com. I have a podcast. It's $50 a year. I'll give you my point of view from a 36,000 point of view. I'll give you the overview of the market and positioning. And if you have $100,000 to invest, you are a U.S. citizen, and you qualify for a long short strategy, I'll manage your money personally in the inflation, deflation, and economic cycle model.
Great. Well, I'll put a link to pentoport.com where people can reach out to you and sign up. Gentlemen, as always, excellent conversation. Thank you so much for coming on.
Thanks, Jesse. Thanks, Michael.
Thank you. Thank you both.